Let's be honest with each other for a second. Deep down, you know something is wrong. You have watched the videos. You have memorized the candlestick patterns. You have drawn the support and resistance lines until your eyes burned. And most importantly, you have followed the golden rule that every single trading guru screams from the mountaintops. You only take trades with a 3-to-1 risk-to-reward ratio. You risk $100 to make $300. You risk 1% to make 3%. It sounds so perfect. It sounds so logical. The math says you only need to be right 25% of the time to break even. So why does your account keep bleeding? Why do you feel like you are fighting a war you can't win? Why are you stressing out, losing sleep, and blowing prop firm challenges while the experts make it look easy? I am going to tell you why. I am going to tell you the truth that the trading education industry is terrified to admit. That golden rule, that 3-to-1 risk-reward ratio that you treat like religion, it is the exact reason you are failing. It is the reason you are psychologically destroying yourself. It is the reason you are blowing up accounts. While you are out there hunting for home runs, professional firms, the ones moving billions of dollars, are quietly doing something completely different. Today, we are burning the rule book. We aren't just going to look at the math, although the math is shocking. We are going to look at what happens to your actual brain chemistry, your hormones, and your ability to make decisions when you follow this popular advice. We're going to expose why the 3-to-1 system is a trap designed to make you fail prop firm evaluations. And we're going to prove why a humble, boring 1-to-1 system is actually the secret weapon of the top 1% of traders. If you are tired of losing, if you are tired of the anxiety, then you need to listen to every word of this, because we are about to deprogram everything you thought you knew about profitability. Let's start with a trap. You have heard 1,000 times, never risk more than you can make. Ideally, aim for 3-to-1 or better. The sales pitch is seductive because it promises laziness. It tells you that you can be a terrible trader. You can be wrong 70% of the time and still make money. On paper. In a sterile spreadsheet, that math is correct. If you risk 100 to make 300, you can lose significantly more than you win and still come out ahead. But you do not trade on a spreadsheet. You trade in the messy, emotional, brutal reality of the live market. And in reality, that math is useless. Why? Because it ignores the single most destructive force in trading, the losing streak. Let's talk about the losing streak. I'm not talking about one bad afternoon. I'm talking about those soul-crushing stretches where absolutely nothing works, where every breakout is a fake out, where every support level snaps like a twig, where you place a trade, get stopped out, reverse the trade, and get stopped out again. These aren't rare anomalies. They are mathematical certainties. And the frequency of these hellish periods is directly tied to your win rate. We need to compare two traders to understand this. Let's call them Mike and Sarah. Mike is the model student of YouTube University. He trades a 3-to-1 system. He risks 100 to make 300. Because the market rarely gives 3 times your risk without a fight, his win rate is 35%. That is actually pretty decent for a 3-to-1 strategy. Sarah, on the other hand, ignores the gurus. She trades a 1-to-1 system. She risks 100 to make 100. Because her targets are closer and easier to hit, her win rate is 55%. Now, conventional wisdom says Mike is the smarter trader. But let's look at their lives. If Mike wins 35% of the time, he is losing 65% of the time. He loses 2 out of every 3 trades. Mathematically, this guarantees that Mike will face massive clusters of losses. 5, 6, 7, even 8 losses in a row. For Mike, losing 8 times in a row isn't disaster. It is a statistical probability. It is a normal Tuesday. Imagine that reality for a second. You sit down Monday. Loss. Tuesday. Loss. Wednesday. Loss. By Thursday, you have lost 8 trades in a row. What is happening in your head? I don't care how disciplined you think you are. After loss number 8, you are not a trader anymore. You are a nervous wreck. You are questioning your strategy. You are scrolling through Reddit asking if the market has fundamentally changed. You are tweaking your indicators. You are hesitating on the trigger. Or worse, you are doubling your position size to make it all back in one swing. Now look at Sarah. She wins 55% of the time. She wins more than she loses. Her losing streaks are short and rare. She might lose 2 or 3 in a row, but then she pops a winner. She gets that dopamine hit. She feels the system working. She never falls into that deep, dark hole of despair that Mike lives in constantly. This brings us to the neuroscience of why the 3-to-1 ratio is destroying your brain. This isn't just psychology. This is biology. There's a concept called reward prediction error. Your brain releases dopamine, the chemical that makes you feel motivated and focused, not just when you get a reward, but when the reward is better than expected. But the inverse is also true. When you expect a win and you lose, your brain chemistry crashes. When you trade a system with a 35% win rate, you are subjecting your brain to a constant, relentless dopamine drought. You are constantly predicting a win, because that is the goal, and you are constantly being punished. Research from MIT and the University of California has shown that this specific pattern of chronic, unpredictable failure triggers a stress response in the body identical to physical combat. Your cortisol levels spike. Your heart rate variability changes. But here's the scary part. This chemical cocktail physically makes you dumber. Research shows that repeated negative prediction errors, losing over and over again, decreases activity in the prefrontal cortex. That is a part of your brain responsible for logic, planning, and impulse control. At the same time, it increases activity in the amygdala, your fear center. So, by the time Mike is on his 8th loss, he physically cannot make a rational trading decision. His biology has hijacked his logic. He is operating out of fear and desperation. There is a psychological state called learned helplessness. It was discovered in experiments where subjects were exposed to negative events they couldn't control. Eventually, they just gave up. They stopped trying to escape the pain, even when an exit was open for them. Traders on long losing streaks develop this. They start to believe that nothing they do matters. They stop following their rules because, in their experience, the rules lead to pain. This is the doom loop of the low win rate trader. Now contrast that with the winner's effect. This is a real phenomenon studied in biology and competitive sports. When an animal or a human wins a contest, testosterone levels spike. This increases confidence, reduces fear, and sharpens risk assessment. It makes them more likely to win the next contest. When they win again, the loop reinforces itself. Sarah, with her 55% win rate, lives in the winner's effect. She wins frequently enough to keep her chemistry optimized. She stays calm. She stays confident. She executes her trades without hesitation because her brain remembers winning. Mike, waiting for that 3-to-1 home run, lives in a state of chronic stress and chemical depletion. He is fighting his own biology every single day. Let's move this away from the brain and look at the bank account. Specifically, let's talk about the prop firm meat grinder. This is where the 3-to-1 advice goes from being misleading to being financially fatal. Most of you watching this are probably trying to get funded. You are taking challenges on passing huge accounts. The rules are almost always the same. Make 10% profit without losing 10% of the account. It sounds fair, but if you are using a low win rate system, you are mathematically almost guaranteed to fail. Let's run the numbers. Mike and Sarah both enter a challenge. They both risk 1% per trade. They both take 30 trades a month. Mike, with his 35% win rate, will win about 10 trades and lose 20. But remember, those losses cluster. There's a very high probability that Mike hits a streak of 8 losses in a row. That is an 8% drawdown. He is now teetering on the edge of blowing the account. He has almost no room for error. The psychological pressure is immense. And here's the kicker. Mike didn't do anything wrong. His strategy works in the long run. But the prop firm challenge isn't the long run. It is a 30-day snapshot. The natural variance of a 3-to-1 system is too volatile for the strict drawdown limits of a prop firm. That is why so many traders fail challenges repeatedly. They're using a strategy that requires a massive sample size to play out, but they are trading in a box that kills them for short-term variance. Sarah, risking the same amount, wins 16 trades and loses 14. Her losing streaks are 2 or 3 in a row. Her drawdown hits maybe 4%. She is never close to the liquidation limit. She has breathing room. She trades without the fear of immediate death hanging over her account. We ran Monte Carlo simulations on this. A 1-to-1 system with a 55% win rate passes prop firm challenges significantly more often than a 3-to-1 system, even if the 3-to-1 system theoretically makes more money over 10 years. In the prop firm game, survival is everything. The 3-to-1 system is a volatility machine, and volatility blows funding challenges. But wait, the gurus say, you need big risk-reward to catch the big moves. This brings us to the myth of trade frequency. Mike is hunting for 3-to-1 setups. These require a specific market condition, a tight stop loss, and a massive, unimpeded run to a distant target. These setups are rare. Maybe he finds 8 or 10 a month. He is sitting on his hands, bored, waiting for perfection. Sarah is looking for 1-to-1 setups. These are everywhere. A standard support bounce, a quick momentum breakout, a trend pullback. She finds 20, maybe 30 setups a month. Now, why does this matter? It matters because of the learning curve. Every trade is a data point. Every trade teaches you something about the market and about yourself. Sarah is getting 3 times the experience of Mike. In 6 months, she has executed nearly 200 trades. She knows her stats. She has seen how her system handles chop, trends, and news. She has adapted. Mike has executed maybe 50 trades in 6 months. That is barely enough data to know if his system is even profitable or if he just got lucky. He is learning at a snail's pace. If the market shifts, Sarah notices in 2 weeks. Mike might not realize his edge is gone for 4 months because his trade frequency is so low. And this leads us to the biggest secret of all, what the professionals actually do. I want you to forget the Instagram traders renting Lamborghinis. I'm talking about proprietary trading firms in Chicago, New York, and London. Firms like Jane Street, S&B Capital, DRW. Do you think they are sitting there obsessed with hitting a home run on every trade? Do you think they turn down a profitable probability because it's only a 1-to-1 risk-reward? Absolutely not. Professional trading is about consistency, volume, and edge. Many of the most profitable strategies in the world have risk-reward ratios closer to 1-to-1. They rely on high win rates. They rely on being right slightly more often than they are wrong, and do it over and over again. They focus on the Sharpe ratio. Essentially, how much money do I make compared to how volatile my equity curve is? A 3-to-1 system has a terrible Sharpe ratio because the equity curve looks like a roller coaster. It goes straight down for weeks, then shoots up in a day. Professionals hate that. They want a smooth, steady equity curve. They want a staircase going up. That is what a high win rate system gives you. The obsession with 3-to-1 is a retail phenomenon. It sells courses because it sounds smart. It appeals to our greed. Risk a little, make a lot. It appeals to our laziness. You don't have to be right very often, but it is a lie that keeps you poor. It keeps you in a state of high stress, high cortisol, and low confidence. So, am I saying you should never take a 3-to-1 trade? No. Context is everything. If you are on a weekly time frame, catching a massive trend, sure, let it run. If the market offers you a 5-to-1, take it. But the problem is the dogma. The problem is rejecting a good trade because it's only 1-to-1. The problem is forcing a target that the market has no intention of hitting just to satisfy an arbitrary ratio you heard on YouTube. So what is the solution? How do you fix this? First, you have to stop worshiping the risk-reward ratio and start worshiping the win rate. You need to understand that your psychology is the most fragile part of your trading system. You need to protect your confidence more than you protect your capital. A system that wins 55 or 60% of the time protects your mind. It keeps you in the game. It prevents the death spiral of revenge trading. If you are struggling right now, I want you to try something. Stop looking for home runs. Look for base hits. Look for setups that just need to move a little bit to pay you. Set your take profit at the same distance as your stop loss. Watch what happens to your win rate. Watch it climb to 50, 55, maybe 60%. Then pay attention to how you feel. Notice that the anxiety starts to fade. Notice that you don't dread opening your charts. Notice that a losing streak is just 2 trades, not 10. Notice that your equity curve stops looking like a heart attack and starts looking like a business. Trading isn't about having the best theoretical math. It is about having a strategy you can actually execute. It is about surviving the bad days so you can be there for the good ones. The trader who wins is not the one who makes the most per trade. It is the one who is still trading a year from now. Mike, with his 3-to-1 system, is going to burn out. He is going to blow his prop challenge, blame the market, and quit. Sarah, with her boring 1-to-1 system, is going to slowly, steadily, and quietly build a fortune. She is going to compound her account. She is going to master her psychology. The choice is yours. You can keep chasing the golden rule that is breaking your bank account, or you can start trading like a professional who understands that consistency is the only thing that matters. Don't let the obsession with risk-reward blind you to the reality of risk of ruin. Go back to your charts. Look at your last 20 losses. How many of them would have been winners if you had just taken a 1-to-1 profit? How much emotional pain would you have saved? How much money would be in your account right now? The answer might hurt, but it's the truth that will set you free. Stop gambling on home runs. Start building a career.